Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is open up your brokerage platform and you want to navigate to any equities underlying, and then you want to pull up a list of expiration dates for that underlying. It doesn't matter what underlying you choose, we're just looking at NEO. We just want to see the list of expiration dates, and we want to pick an expiration date that we can use to mock up positions on other underlyings. All expiration dates for equities are the same, so it doesn't really matter. That's why it doesn't matter which one we choose. So the one that we want to lock in on needs to be between 30 and 60 days out in time, and it also needs to be a monthly expiration date, not a weekly or quarterly. So the only expiration date that fits that criteria right now is January 17th, which is 42 days out in time. So we can take that information, come over to our watch list. This is just an options watch list, but we can take that information, come over to, let's just say, the Tasty IVR watch list, and we can filter out how many days away was it? 42 days. So we can filter out all underlyings that have earnings over the next 42 days. And the reason for this is because we don't want earnings to come along and disturb our trade. It will increase volatility and mess up our deltas. And all of these things are going to have a negative effect on our P&L. So we want to avoid it. And we also want to filter out anything that has a low liquidity rating level. We only want to trade liquid underlyings with liquid options to ensure that we can get in and out of positions easily, and to make sure that we are only paying tight spreads and not wide spreads. So what you'll be left with is something that looks like this. Obviously, the underlyings will depend on what's on your watch list. This is just a pre-made one. It doesn't really matter too much. And I like to order everything from high to low IVR. The reason for this is because we want to sell premium when volatility is high and play the contraction back down to the mean, and hopefully further below. So at this point, we just go down the list and we see what would fit well inside of our portfolios. Now, you want to keep in mind what's already in your account, what's already in your portfolio. If you're heavy in any one sector, try and go for something else in a different sector. Don't, if you're very heavy in tech, don't go and look for a position on Microsoft, for example. Use common sense and you'll be fine. So you just go down the list and see what looks good. You want to see, obviously, what it is. You want to see, you want to look at what it's trading for. You want to have a look at the IV rank. You want to have a look at the liquidity rating. You want to have a look at the absolute IV level as well. So LYB is looking pretty nice. CE is looking fairly good here. I typically like to trade things with either a 3 or 4 star liquidity level. So CE has got 3 stars here. It's got an absolute IV of 40.1%, and it's got an IV rank of 61.1. Anything above 50 can be considered high. Anything below can be considered low. There are exceptions to that. Sometimes over 30 is fine. So let's just have a look at CE, and we know we're going to be at January 17th. Now, at this point, we want to make sure that we are uh, looking at some tight spreads here. So $6, 6.50 is not the best. An 11 delta, 25 cents, 70 cents. That's not the best. So we're not going to go with that. We've got mRNA here that we can have a look at. Let's have a look at mRNA January 17th. Let's have a look at the spreads here. Much tighter spreads, 10 cents wide, couple cents wide. And again, on the put side, 10 cents wide, 15 cents wide here, 10 cents wide. mRNA is looking much more attractive at this stage. I hope you could see the difference between the two. We're looking at the difference between the bid and ask. That's the spread. So we're going to go with mRNA. Moderna, it's got an IV rank of 59.9, an absolute IV level of 83.3% on this expiration date, which is really nice for us. And we're gonna do what we always do, which is sell one call and one put, and we want to sell them anywhere between a 15 and 20 delta. So we've got a 20 delta on the call side and we've got a 27 delta on the put side. There is no 15 to 20 delta. The best thing we've got is either 13 or 27. However, because IV is high, the absolute IV level is looking pretty nice. I'd be tempted to go maybe slightly heavier on this position, 27 delta and a 30 delta. You want to be very careful when doing this, but this is probably a good time to show you what it looks like. This orange bar is, of course, the expected move, and this green bar is our break even. So our break even bar is overshadowing the expected move, which is going to lead to a high probability of success for us. And you can see that here with a 63% probability of profit and 70% chance of hitting 50% of max profit at some point in the next 42 days. We would collect $438 up front in premium, and we keep that no matter what happens. And our broker is going to require just under 2.2k in buying power. So very, very nice return on capital for this trade, and we've still got a very nice and high probability of success. Now, if 2.2k is too much for your portfolio, that's not a problem. You can simply just buy another contract a little bit further out, say $5 wide, and then the same thing on the put side, $5 wide, and you've created a $5 wide spread on either side. Our loss is now limited, it's no longer unlimited. Um, our loss is defined. It's defined by the difference between the short and long strikes, which is $5 minus the premium that we collect, which is 2.84 multiplied by 100 contracts, because each contract controls 100 shares. Sorry, not multiplied by 100 contracts, multiplied by 100 shares, because each contract controls 100 shares. That's how we arrive at our max loss here, and our broker is only going to require what our max loss is in buying power. So we reduced our buying power requirement from just under 2.2k to just under $300. This should now be much more manageable for most people. We do have a much higher return on capital here now, much higher. The trade-off is that we have slightly lower probabilities of success. So there's no such thing as a free lunch in the market. If you gain something, you have to give something, and that's the trade-off. However, this is a perfectly uh, reasonable position here. It looks pretty nice, to be fair. And by all means, if this is something you want to put in your portfolio, by all means, feel free to do so. If you want to know how much buying power you should be allocating to each position, we have got a free position sizing template that's available for everyone to use and get a copy of. Link is in the description. Just click on this button here. It will take you over to this template. The way it works is you enter in the size of your portfolio. Let's say you've got 100 grand, and then you enter in what the current VIX level is. Let's say if it's 14.2. Everything below will then be automatically calculated for you. And at this point, you can use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power you should be allocating to any single defined risk position, any single undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general, and an explanation of everything below with a little chart of portfolio allocations with respect to the VIX level. So as long as you follow this, you'll be absolutely fine. Link is in the description. If you want to learn in more detail about what we do and how we do it, again, link in the description. This time, click on EDS Premium and get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, the adjustments that we're making, how we're managing risk, all in real time. There's also a full course inside, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. This allows you to learn the theory and see it applied in action in real time. If at any point you get stuck, there is a private community, so you can speak with myself directly and with other like-minded individuals to get help. There's a 100% money back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. And right now it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.